Crypto contagion. History rhymes. Investors will always chase what's hot, including pixelated images of gorillas valued at hundreds of thousands of dollars. Then immediately think, just get me out, when it's not. The common sense indicator never fails. It's been a tough couple of weeks for most market sectors, but for crypto especially. And there's one major question. How far will crypto chaos spread? Now, if you're not in the know, here's what the chart of Bitcoin looks like year to date. You can see the drop from April, down 57%. The Bitcoin market has been in free fall since late April, when it last traded above $40,000 per Bitcoin. Bitcoin's bear markets. Like many other volatile asset classes, Bitcoin's highs and lows will leave even the most diamond hands holders sweating. This current swing is no different. Bitcoin is down 68% in this recent downturn. For anyone who has levered up in crypto for more than a day trade is on the verge of liquidation. So let's put Bitcoin's historical corrections or crashes into perspective, as you can see in the chart we put together right here. And what you're looking at in the red arrow, the red line, is where the current Bitcoin price fall is relative to the other four Bitcoin corrections. The biggest correction was down 93%, and the least was 53%. So the current correction is the second least out of 5. If history is any indication, both the duration, so how long it's been going on the bear market, and the severity of the decline of Bitcoin prices is not finished yet. Have fun getting poor. Bitcoin has always been a volatile asset. The constant battle between diehard holders and the naysayers has seen Bitcoin jump over 600% before falling by 70% in just the last 2 years alone. Telltale signs of market tops are always evident in rearview mirror and hindsight. But I've seen my share of bull markets and what accompanies them. Laser eyes, shaming anyone not in with the likes, and have fun staying poor. Displays of excess, bragging about Lamborghinis and photos on social media, including boats, celebrities at parties, and crypto events. I was reminded of the time a senior member of Katusa Research, went to a conference and was invited to a VIP dinner during the cannabis boom. Executives of a company that just raised $20 million were spending lavishly on dinner and magnum bottles of vintage wines. And as it reported back to me, everyone was congratulating each other, but all they had was investors' money and nothing tangible to show for it or in the pipeline, he told me. The industry spiraled soon after. Sound familiar? The Stablecoin Spiral. Are stablecoins really stable? There was a series of events that played a major part in Bitcoin's most recent downturn. It's related to something known as stablecoins. Stablecoins are a fairly old innovation on the cryptocurrency timeline, with the first ones launched in 2014. A stablecoin is any cryptocurrency that is pegged to a different asset, like a real currency, commodities, or even another cryptocurrency. A simple example of a peg would be the former gold standard. Back in post-World War II era, under the Bretton Woods system, the US dollar was pegged to gold. You can convert an ounce of gold to 35 US dollars, and vice versa. Stable coins operate under the same ideology, but of course not to gold ounces. One of the most popular stable coins, for instance, is Tether, also known as USDT. Every Tether coin is backed by $1 US, giving it a 1-to-1 peg with the currency and stabilizing the price of UST at $1 USD to the dollar. In theory, this means that a Tether holder can convert their coins for $1 at any time. This low price volatility, combined with the guarantee of an asset backing the coin, has made stablecoins very popular investments. Tether, the leading stablecoin, regularly outtrades Bitcoin itself in terms of dollar volume. Recent events, however, have caused investors to rethink just how stable these stable coins really are. The wrong way to the moon. The first sign of trouble came in early May when stablecoin Terra USD and its sister currency Luna crashed. That's the chart you're looking at there, essentially from $1 to nothing. As a brief background, Terra USD was an algorithmic stablecoin. Though its value was tied to the US dollar, much like USDT, the way it did this was much more complicated than a simple peg. Terra's sister coin, Luna, was used to keep the price of Terra in check. By selling off Luna to create new Terra coins, or vice versa, the price of Terra was maintained at the $1 US mark, thanks to an algorithm designed by the coin's developers. But this algorithm broke down last month catastrophically. Previously, almost 75% of the total circulation of Terra was held in a lending and borrowing system known as the Anchor Protocol. Holders of Terra were rewarded for parking their coins in the Anchor Protocol with a fixed 20% interest rate. Remember that common sense indicator I brought up earlier? A 20% yield is a red flag on the common sense indicator. Rumors that Anchor was changing their fixed interest rates to variable ones, however, triggered massive withdrawals of Terra. As more and more people decided to sell their Terra, this caused the supply of Luna to shoot up. The oversupply led both Terra and Luna to a price crash. This vaporized $40 billion of market value and left many hopeful crypto investors empty-handed. Key lesson: beware of markets that can get illiquid fast. The Contagion Spreads. Shortly after Terra's initial drop, widespread worry over the situation would spread to other stablecoins. And not even Tether, the poster boy of stablecoin market, was spared. As you can see at the chart right now, the cracks are starting to show. Despite a supposed one-to-one backing to the US dollar, Tether fell as low as 95 cents in the wake of Terra's collapse. It was a clear sign that crypto investors had their confidence in stablecoins shaken. And just last week, Tether's peg was tested once again. Two major crypto firms, Celsius and Binance, froze client withdrawals. Common sense indicators should be tingling. The fresh wave of fear that followed this news would again cause Tether to briefly slip to 98.12, well outside its usual trading range of 3/9 to $1.001. On top of this, there's major concern over Tether's fiat currency backing. It isn't held solely in cash, but also partly in things like commercial paper, meaning unsecured short-term debt. This is alarming to stablecoin investors. If Tether cracks, look out. This isn't a new issue. Back in 2021, Tether was banned from and fined $18.5 million by the city of New York for lying about their cash reserves. The Office of New York's Attorney General found during their investigation that Tether had not been fully backed by US dollars at a 1-to-1 ratio at several points in 2017 and 2018. Tether has refuted rumors about the composition of its commercial paper holdings and have committed to eliminating all corporate debt from their portfolio. But it's clear that investor faith in the stablecoin is not as solid as it used to be. And if what happened to Terra were to happen to Tether, one analyst has said it would be like a Lehman Brothers moment for the crypto markets as a whole. Those who fail to learn from history. As one Reddit user so eloquently pointed out, right now the crypto markets are speed running through the late 19th and early 20th century of banking. Ponzi and pyramid schemes, the slow shift towards fractional reserve banking, uninsured and unregulated banks, exit scams, and bank heists. The Wild West all over again in the crypto markets, only it's playing in fast forward. Bitcoin's current situation is a far cry from the author of the S2FX model, and if you want to read the link, click here. We nailed this about a year and a half ago. Who rode BTC, the Bitcoin from 69,000 all the way to 20,000. Thought the model would beat. In fact, the loudest voices stopped pounding the table on the S2FX in their recent Twitter posts. Now there's more talk of alternative trading indicators and models, as well as proper portfolio allocation. But as I constantly have to remind my haters, I'm not blindly bashing crypto. All I'm trying to say is that with all of the hype and baseless optimism surrounding the crypto markets, you need to be careful with your money and selective with your investments. That's how I manage my portfolio. And if you want to see exactly how I'm preparing to deploy my capital in these times of uncertainty, please click here with the link shown. It details how I stay defensive with my own money when most others are losing their heads with greed and fear. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.